Hello, everyone, and welcome to our webinar on smart philanthropy. Today, we're diving into the world of strategic giving and how you can maximize the impact of your philanthropic efforts. I want to thank you for joining us today as we discuss this important topic, a topic that frequently comes up during our financial planning process. The presenters for today's webinar are Harmony Wagner and Catherine Buck. Harmony is a senior member of our advisory team. Harmony is a certified financial planner and also holds the advanced designation of a certified private wealth advisor. Katie is an integral member of our advisory and financial planning teams. Katie passed the rigorous CFP exam earlier this year and is working towards achieving her full CFP designation, hopefully by the end of this summer. Through a series of case studies, Harmony and Katie will be covering the application of several philanthropic strategies, including the use of donor-advised funds, charitable remainder trusts, and private foundations. So again, I want to thank you for joining us today, and we hope you find this webinar on smart philanthropy both informative and inspiring. Please welcome Katie Buck as she starts off the presentation.
Thanks, John. Before we begin, let's review some charitable giving statistics. Fidelity Charitable gathered 2023 year-end data forecasting 1,000 donors' charitable intentions for the future. Of the key findings, a third of the people surveyed, around 30%, intend on giving more this year. Behind this charitable sentiment, a change in salary and income have driven people to feel more philanthropic, and their interest in the charitable cause has made them passionate about giving more. It is important to note, however, that other donors feel barriers to their charitable giving. Of this survey, around 81% of people worry about the nonprofit's transparency and the impact their donation is making within the organization. And 75% of people felt their personal finances have affected their charitable endeavors. Working with a financial advisor can help you navigate these uncertain waters and provide clarity in your charitable giving strategy while aligning with your values and intentions. So today, Harmony and I will be reviewing 3 case studies, as John said. We will start each section by reading the case study and then dive into the charitable strategy recommended. With that being said, let's get started. Our first case study is called The Happy Family. Elaine is a mother of 2 and files jointly with her partner Sam every tax season. She and Sam spend their weekends with their children and attend church services every Sunday. They are charitably inclined and donate around $5,000 annually to different charities, such as the Humane Society, American Cancer Society, and their church. Elaine received a bonus this spring, which has pushed them into the next marginal tax bracket. Their CPA, George, projects that they will owe taxes this year as a result. George believes if they maximize their itemized deductions, they may be able to come out net neutral for the tax year. The couple have a brokerage account with highly appreciated stock position in Google, which was a gift from Elaine's father. She's been seeking to diversify out of this position, but wants to avoid capital gains tax. Now that we've read our first case study, let's review a recommended philanthropic strategy using a donor-advised fund. So what is a donor-advised fund? A donor-advised fund is a charitable giving vehicle managed by an advisory firm. The donor or client will make a contribution to the fund and receive an immediate tax deduction within the tax year of the donation. The client can then take those funds directly to the chosen charity or allow the funds to grow and make those charitable donations further down the road. This is illustrated through the image on the right. The advisory firm manages the investments and the record keeping, making this charitable giving strategy very low maintenance. It is truly ideal for those seeking hassle-free charitable solutions. Some common strategies used with a donor-advised fund are front-loading donations in a high-income year. This is when a client contributes multiple years' worth of donations to the donor-advised fund in one tax year to maximize their charitable deductions. Another strategy is donating appreciated stock positions to divest from your concentrated stock within your portfolio without incurring capital gains tax. Now let's look into why a donor-advised fund would work well for Elaine and Sam. Elaine and Sam have an opportunity to take advantage of front-loading a donor advised fund and diversifying their portfolio. Elaine and Sam are already charitably inclined and give $5,000 annually across many charities. Additionally, Elaine has significant single stock risk in her portfolio due to the gifted Google stock. To kill two birds with one stone, Elaine could front load her donations. Let's say her CPA recommended 3 years worth of donations, or around $15,000 of her Google stock, to be donated to the donor advised fund, which would then be sold and reinvested appropriately without incurring any capital gains tax. They now have successfully divested from her concentrated, highly appreciated stock position and maximized her itemized deductions for 2024. Now the couple can continue on as usual and donate the $5,000 to their favorite charity this year, and then leave the $10,000 in the fund to grow and use for future donations. Now that we've covered case study 1, let's move on to our following case studies presented by Harmony.
Thank you, Katie. This next case study I'll share, I've titled Balancing Income Needs with Charitable Goals. I think that's something that a lot of clients may resonate with. So let's dive in and read this case. Here we have Jerry, who's a 65-year-old retiree living in New York State. He collects Social Security and a pension and takes monthly distributions from his investment portfolio to supplement his living expenses. His income puts him in a 32% federal tax bracket. Jerry has a highly appreciated stock position in Apple that he bought in 2006, which continues to grow, creating significant single stock risk in his portfolio. He'd like to diversify his portfolio, but is concerned about incurring additional tax liability. Jerry's partner passed away 10 years prior. They never had children, and Jerry's not close with any of his living relatives. He enjoys spending his money on travel and fine dining. He also makes annual donations to his alma mater, Boucher University, as he's a passionate alumni. Of course, that's fictional for anyone who's wondering. Now, based on Jerry's situation, we would recommend that he partner with his financial advisor and an estate attorney to create a charitable remainder trust. So what is a charitable remainder trust, or CRT? This, at a high level, is a trust that provides lifetime income to one or more individuals, with the remainder going to charity. So if you look at this diagram on the right, you can see the donor is gifting assets to the trust. These are typically highly appreciated assets or assets that are not otherwise the most tax advantaged, such as an IRA is one strategy you can use. These assets that are now in the charitable remainder trust are used to create an income stream to one or more beneficiaries. There's a lot of flexibility there. It can be the donor or other parties, maybe a spouse or children, someone else that he'd like to be the income beneficiaries. There's flexibility in the time frame. It can be over the income beneficiary's lifetime, or it can be for a set term, not to exceed 20 years. But you can say, for 10 years, I'd like this income paid out to myself or someone else. And at that 10-year point, the income period will end and the remainder will be gifted to charity. You can also structure it with different options on the payout amount and the payout calculation. So some of these trusts are calculated on a fixed percentage of the trust assets. So it may be structured where 5% of the assets each year are distributed to those income beneficiaries, again, for a set term. You could also do it where it's a fixed amount. Maybe you have $10,000 every year, regardless of what happens, to the market value of the trust. You have a fixed amount that's paid out. So you can structure it really in whatever way makes the most sense for your situation. Now, what are some of the tax benefits? So the donor is funding the account, and that donor receives a current year income tax deduction. Now, the deduction is not the full value of the assets that are used to fund the trust, because the full value of the trust assets isn't going to charity. A portion is getting distributed to those non-charitable parties prior to the remainder going to a charitable organization. So instead, the deduction is a lesser amount that's equal to the value in today's dollars, so it's discounted for inflation, of the amount that is estimated to go to charity at the end of the income timeframe of the trust. So there's an IRS approved method for calculating that, and that would be the deduction. So let's say, Jerry has maybe $100,000 of Apple that he's putting into his CRT. Perhaps his deduction is something more like $20,000. It's a discounted rate based on how much is expected to go to charity and then discounted back for today's dollars. Once the assets are in the trust can sell the appreciated assets tax-free. That's one of the major benefits of this strategy. Similar to a donor advised fund, except that with this type of strategy, the income beneficiaries are still getting income off of it. So you're moving that highly appreciated stock into the fund, into the trust, excuse me, and the trust can sell it and diversify without realizing any taxes. This is very compelling for folks with investments that have significant built-in gains. You can use this charitable trust wrapper to avoid those gains and still generate income for the beneficiaries. Now, the beneficiaries will pay tax on the income that's distributed to them, and that tax all depends on the characteristics of the income within the trust. So it could be taxed as ordinary income, could be capital gains. It could actually even be a return of principal. A lot depends on what's going on within the trust. But it's important to note that the income isn't tax-free to the non-charitable beneficiaries. However, the things that occur within the trust, sales, interest income, dividend income, the trust is not paying tax on those, nor is the donor. Two other important notes. So donations to a CRT are irrevocable. You're going to be getting a current year income tax deduction. So it really has to be a final gift to charity, not something that you can then pull out later to use for a different purpose. So it is irrevocable. However, the donor does have the ability to modify the charitable organization who's the remainder beneficiary at any point while the donor is still living and while it's still in the income period of the trust. So if, let's say, Jerry and Boucher University have a falling out, they're not willing to put his name on the library, he can change that from Boucher University to another charitable organization. So that kind of protects you in the event that, you maybe don't want to support that exact cause anymore, or if that institution or organization isn't around anymore at the end of the income time period, you have the option to adjust it to another qualified 501c3 organization. So this is ideal for donors who have current cash flow needs and or highly appreciated assets. Let's go to the next slide where we talk a little bit about why this is a great fit for Jerry. So Jerry has immediate cash flow needs from his portfolio. And he also has this strong charitable inclination to his alma mater. So the CRT allows him to plan a major donation to an organization he's passionate about and also provide predictable income for his lifetime. This is a concern for a lot of people. Of course, you want to support charities, but you don't want to do so to your own personal detriment. So having something like this is a way to, create an income stream. Again, it can be for yourself. It can be for another financial dependent, spouse, child, someone else that you care about who's not a charity. You can create that income stream for them and then make sure that, the rest of it's going to charity at the end of that time frame. As we know from the case, Jerry's in a relatively high tax bracket, so the current year income tax deduction will be advantageous for him. He also has the highly appreciated Apple stock, which he can use to fund the CRT. And once it's in that trust, the stock can be sold tax-free and allows him to diversify without paying, personally paying capital gains tax on it. So that's appealing to someone in a high tax bracket. Now, why would you use a CRT as opposed to just leaving charity, your money at the end of your life, or even using a donor advised fund like Katie talked about? There's some specific reasons why a CRT is more advantageous for Jerry. First of all, if he just leaves the money to charity at the end of his life, he doesn't get that current year income tax deduction. And he also doesn't have the opportunity to diversify out of Apple. So he has that single stock risk that we know he's concerned about. If he just leaves, puts charity as the beneficiary on his brokerage account, that doesn't allow him to sell that tax-free. So that removes that important element. A donor advised fund would allow him to move highly appreciated stock into it, but it doesn't give him that income element back to himself. And we know that's another concern of his is he still lives off his portfolio to support his lifestyle. So for that reason, a CRT is a much better fit than some of the other options that are out there that would only accomplish one or two of his goals. The CRT really addresses his own personal needs and his charitable goals while maximizing the tax and diversification benefits. Another quick note on CRTs before we move on to the final case study. These really do come into favor when interest rates are higher because of the way the current year income tax deduction is calculated. So because it's discounted for today's dollars and that calculation, when we're in a higher rate environment, it makes that calculation work out better for the donor. They get a higher current year deduction. So if this is something that you're interested in or considering, it could be an opportune time to do so with the interest rate environment that we're in. So just another important note, if this is appealing to you and you think it may fit your situation, have a conversation with us about whether now might be the right time to set up something like this. Next, we'll move on to our third and final case study, a generational legacy, in which we'll explore what I would probably consider the more complex of the three strategies that we're going to be discussing today. The Kramer family are well known in their town and have amassed generational wealth from great-great-great-grandma Kramer's barbecue sauce recipe. 4 generations live within minutes of each other and are a very close-knit group. Grandpa Kramer, the patriarch, worked as a financial advisor before retirement, which inspired his daughter to pursue her financial career in accounting. The family passionately donates to charities that benefit regional food banks in towns similar to their own across the country. Recently, Grandpa Kramer has been unhappy with the management of the family's donations and believes it would benefit them to actively manage and distribute the funds themselves. He hopes to keep the spirit of the Kramer family's philanthropy alive for generations to come. So based on the Kramer's poor experience with the way the donations were being used, and along with a couple other factors, their advisor is going to recommend that they consider establishing a private foundation. So what is a private foundation? It's a not-for-profit organization. It's typically funded by a single source. So often an individual donor or their family is that major initial funding source for this organization. Not to say that they can't make later donations down the road. And also they can receive donations from other unrelated parties, but typically, especially with a family foundation, it comes from the family's wealth as that funding source. These foundations can support charitable activities through a variety of different ways: grants, scholarships, direct programs, and even there are many ways that they can kind of structure themselves to meet whatever their particular goals and passion and direction is. The foundation is staffed by its donor and their family typically, and the foundation is responsible for investing and managing their funds along with record keeping and other administrative requirements. It can be quite the labor-intensive thing to do, quite an undertaking. So it doesn't always have to only be the donor and their family. They're kind of the main drivers for the way it's operated, but it's pretty common and usually advisable for them to bring in other professionals and experts in this space to help with the management of it. It's important to get everything right as far as the IRS regulations to qualify as a private foundation to get those tax and estate benefits. So there is quite often just that you'd see other platforms, other parties, experts brought in. Because it's operated by the donor and family, they have the flexibility to donate to a variety of charities and to do so in the way that makes the most sense for them. So because they're managing it, they have complete flexibility, who they want to support, what that's going to look like, how they're going to vet the end beneficiaries of these donations to make sure that their real purposes are being accomplished. And that's really the main benefit to this type of strategy. There's an annual 5% distribution requirement that's set by the IRS. So these foundations have to distribute that much at least per year. And that is only the tip of the iceberg in terms of the kind of IRS requirements and regulations that are out there for a private foundation to be qualifying. So, this is very high level. There's a lot of nuance here. If you're interested in it, it's certainly worth exploring with some, expert advisors in this area. Just like donations to other charities, there are income tax benefits for donations made to private foundations, again, as long as they're qualifying. And there are also estate tax benefits for those high and ultra high net worth families that might be affected by it. You can reduce your taxable estate by donating to these private foundations, whether during your lifetime or as a bequest. They do have some high administrative costs, both monetary, and also there's a lot of time and effort required. So that can be a deterrent to some folks, but they are ideal for donors who really want that control, a high level of control in managing their finances and charitable endeavors. So why is this a good fit for the Kramer family? Control is an important element for them. One of the main barriers to people giving more to charity is that they have doubts about the way their funds will be used. Maybe they're concerned if they give money to an already existing nonprofit, they feel those funds are going towards paying, high salaries for board members, and that may not be what someone wants their particular dollars going towards. So that's the situation we're seeing here with the Kramer family. They have a strong desire to donate. They already know, what causes they want to support. They have a clear direction, and they're in a financial situation to give generously without it impacting their own financial health or lifestyle. So really their main concern is ensuring their donations are used properly and according to their wishes. And I think a secondary concern for them would be that income and estate tax element. We know they're a, generational wealth family. So probably in that arena where they're concerned about that and very attentive to it. Another element that makes us a good fit for them is that we know the Kramer family members have the time, desire, and expertise to run a foundation. I mentioned how labor intensive it can be. We have Grandpa Kramer, who was a financial advisor in his career, so he has a little bit of knowledge in this space, but he's retired now, so hopefully that means he has a little more time to devote to it. And he also has his daughter with an accounting background. So this is an important piece to the strategy. Within the family, there are people who know, at least on some level, how to handle this, probably know when they need to get other people involved. And so they are kind of bent that way to do a good job managing an organization like this. I also would note that the multi-generational aspect is compelling here. It's not just an older family member taking the lead where after he's no longer around, the foundation might struggle. His daughter is also interested in and wants to be involved and has that knowledge base. So it's likely that for their particular goals, they want this to be a generational legacy. They have a really good chance of doing that, especially as they involve more members of the family. Seems like this is something that they all are passionate about. This isn't a necessity, if you're considering this, but you're saying, oh, I don't have a child that I think might want to take over. It doesn't mean that the foundation can't work for you, but for their particular goals, it does make it extra appealing. Finally, I had mentioned that there are higher administrative costs, higher time required. For the Kramers, their desire to oversee the management and the way the funds are used really outweighs that cost for them. It makes it worth it because they've been trying it a more simple way, giving to already established organizations. It's not really meeting their charitable needs. So this is a good time for them to consider something that's a little bit more work, but that really accomplishes their goals. I'm going to hand the presentation back to Katie to close, but before I do, I just want to encourage you to engage with us on these kind of conversations. We've shown you 3 different situations where these types of strategies can work. There are so many more use cases. There's so many nuances that could make it really suitable for our clients. So if you have a particular interest in one of the strategies we discussed today, please reach out to us. We'd love to help you with the strategy and the implementation and workshopping how it could fit your family, your situation. Maybe you're not sure if one of these applies, but you do have charitable inclinations and you want to explore those ways to maximize your impact. We can help with that too. So please do have those conversations with us. We're also passionate about it here at Boucher and would love to hear what you're passionate about and help you get there. So with that, I'll turn the presentation back to you, Katie, for some final thoughts.
Thanks, Harmony. That was wonderful. As our webinar comes to a close, we'd like to reflect on other ways that you can give back and be charitable. Donating your time and energy to a cause that matters to you is just as valuable, if not more so, than donating money. You can donate your skills and knowledge, and you can raise awareness in your community to make a difference. Some ways you can financially make a difference that may be more applicable to your situation could be naming a charity as a beneficiary on a financial account. If you must choose, sometimes we recommend considering an IRA as it does not get a step up to cost basis when it passes to a beneficiary. Also taking advantage of QCDs or qualified charitable distributions when you reach RMD age, which is the age at which you are required to take a minimum distribution from your IRA annually. And instead of taking that distribution, especially if you don't need the funds, you can choose to make a qualified charitable distribution directly to a charity. You will not pay income tax on this QCD, and so really the full amount of your RMD can be donated. If you have any other questions about the content we discussed today, please feel free to reach out to us. As Harmony said, we are charitably inclined. We like to help our clients really discover what means the most to them, and we're really happy to guide you to the most appropriate charitable solution for your specific situation. Again, thank you for joining us, and have a nice day.